This section of our material focuses on the financial markets. What are they and how do they work? In the first part of this section, I'll discuss the various markets and how market efficiency works, and in later sections, I'll discuss the primary and secondary markets and the legislation that governs how financial institutions operate. We typically define a market as a regular gathering of people for the purchase and sale of provisions, livestock, and other assets. We break markets up into two different categories, the market for real or physical assets and the market for financial assets. Let's talk about real asset markets first. Real assets are tangible. You can touch them. These assets include gold and other commodities, jewels, art, basically anything that you can touch. Financial markets are the markets for financial assets, or assets that are intangible but derive their value from real assets. Intangible assets just meaning something that you can't touch. Financial markets include the markets for stocks, bonds, derivatives, and futures. The goal of financial markets is to bring together borrowers, savers, firms, and investors for the purpose of managing funds, which are sometimes called either capital or cash. Investors with too much cash to consume right now provide it to firms or governments that need that capital in exchange for a return on their investments. Governments use those funds to provide national defense, Medicare, and discretionary spending. Firms typically use those funds for capital budgeting projects. Let's take a look at how the flow of funds occurs in a market. Let's start with direct transfers. When savers or investors have cash they don't need right now, they can invest that cash in stocks or bonds of businesses. In exchange, they receive dividends or capital appreciation from the stock they purchase, or capital payments and the face value of the bond they purchase. Indirect transfers through an investment banker occur when a business reaches out to an investment banker to help them issue either stocks or bonds. The investment banker will reach out to their clients and help the firm sell the new shares of stock or new bonds to the bank's clients. The firm gets the funds, the bank's clients get the stocks or bonds, and the investment banker earns a fee called flotation costs, which are typically a percentage of the funds raised. Finally, a firm can raise funds through a financial intermediary. In this case, the firm borrows money from a commercial bank or savings bank. The bank has pooled money from savers who have made deposits at the bank, and the pooled money is lent out to this firm or other firms in exchange for an interest rate. The depositors receive an interest rate as compensation for giving up their cash in deposits, albeit their interest rate is going to be lower so that the financial intermediary can make a profit. Now let's talk about market efficiency, one of the most important concepts in all of finance. We refer to the theory that investors will appropriately respond to new information as the efficient markets hypothesis. In his 1970 paper where he introduced the efficient markets hypothesis, Gene Fama noted that a market in which prices always fully reflect all available information is called efficient. We assume that any new information will lead investors to buy or sell new shares, which will lead the price to adequately reflect the underlying information about the future cash flows of that firm or its stock. We also expect that prices will be adjusted for risk. So let's say, for example, that 1 week from now, one stock is going to have a 50% chance of having a $900 price per share. And there's a 50% chance that the price per share of that same stock is going to be $800. Based on the efficient markets hypothesis, the expected price would be $850, discounted to the present at the risk-free rate. There are 3 degrees of market efficiency. The weakest form is appropriately named weak form market efficiency. In this form, we assume that all information contained in the historical price, return, volume, or short interest data is factored into the price of a stock. The second form of market efficiency we have is the semi-strong form. In this form, we assume that all publicly available information is reflected in stock prices. This means that not only do we consider historical trading data, but we also consider all information that concern the state of the firm's relationship with its biggest buyer, the likelihood that the firm's patented drug is not approved by the FDA, any information that could be value relevant, that could affect the cash flows the firm and its shareholders receive in the future is going to determine the share price of that stock. The third form is the strong form of market efficiency. With this form, we assume that any information, regardless of whether it's public or private, is going to be factored into the share price. For example, let's say that the CEO or one of the lower level employees knows some information that the general public doesn't. The strong form of market efficiency would say that immediately, as soon as the CEO or some lower level employee knows that information, they or someone they know is going to use that information and make a trade. If it's good information, they might buy shares of the stock. If it's bad information, they might want to sell shares of stock before that information goes public. Under the efficient markets hypothesis, every asset should be priced based on the return the stock is expected to receive. This theory also suggests that if two stocks are equally risky, they should offer the same return. The reason we say this is because if two stocks are equally risky and one offers a higher expected return than the other, investors would all want to buy this stock that offers the higher return. As a result, the more desirable stock's share price will be bid up and its future expected return would decrease. And eventually, what we would see is that these two stocks would offer the same expected return. There are cases where some stocks offer what we call abnormal returns, or returns that are more than what's justified based on the risk of the stock. Typically, we define risk in finance as the standard deviation, aka volatility of the stock's returns over time. An example of an abnormal return would be the one that I have listed on our slide. In this example, there are two investments, each with the same amount of risk, or standard deviation. One offers a 7% return, while the other offers an 11% return. The additional 4% return on the second investment is an abnormal return. The efficient markets hypothesis states that every asset should be appropriately priced. If this is true, then we shouldn't see an abnormal return, ever. The fact that we do occasionally find abnormal returns suggests that perhaps either our risk measure is not appropriate, or markets just aren't as efficient as we would expect. There are a couple of other theories, but these are the two big ones. Now, the current US stock market is fairly efficient. Stock prices adjust immediately, or pretty darn close to immediately, to newly released information that's value relevant. The markets in other countries, however, namely the third world countries, are far less efficient. Information that might be useful or predictive of future stock returns is reflected more slowly in the price of various stocks. And we typically see that anomalies in third world countries are typically higher than they are in the United States. Now let's talk about the financial markets that we as investors tend to focus on. First, we have the money market. The asset class known as the money market consists of the market for all securities that have a maturity of 1 year or less. That's a surprising number of assets. So for example, we have T-bills, which are the short-term debt issued by the US federal government. We also have commercial paper, which is the short-term debt of blue chip or low-risk firms. Banks can also issue certificates of deposit that individuals can buy. These assets are sometimes referred to as CDs, and they allow individuals to lock up their money for a short period of time in exchange for earning a small interest rate or return on their investment. There are a couple of other assets in the money market, like money market mutual funds or brokers' calls, but we'll leave off our discussion for another time. Capital markets are the markets for long-term securities. Usually, we think of capital markets as the markets for stocks or bonds. Essentially, any stock or any bond with a time to maturity of more than a year is considered to be in the capital markets. The market for long-term bonds is sometimes referred to as either the debt or the bond market. This is the market where loans and bonds are traded. A bond is just a commitment in which the borrower, which is usually a firm or government, borrows a certain amount of money from an investor, and the borrower compensates the investor with an interest rate or return on their investment. We have a large number of bonds in existence, and they come in all types and sizes and shapes. We have municipal bonds, we have long-term government bonds like T-notes and T-bonds, we have long-term corporate bonds, and we have a number of other specialized bonds or debt issuances like mortgage-backed securities. The equity market consists of the market for common stock of companies. The stock exchanges allow investors to trade shares of this stock amongst each other. The derivatives market is the market for securities that get their value from the values of other financial assets or real assets like commodities, bonds, or stocks. Derivatives are broadly classified into either options or futures and forwards. Options are derivatives that offer their owner the right but not the responsibility to exercise that option. The two most widely used options are call options and put options. Call options afford an investor the right to buy an underlying asset at an agreed upon strike price. Put options provide the right to sell the underlying asset at an agreed upon strike price. Call options are typically used when you expect the price of the underlying asset to increase, and put options are usually used when you expect the price of the underlying asset to decrease, and you want to make money on that decrease in the value of the underlying asset, or you just want to hedge your risk. Futures contracts are agreements made today regarding the delivery of an asset at a specified delivery or maturity date for an agreed upon price called the futures price to be paid at maturity. Futures contracts lock in the price one party will pay the other at a future date for a certain quantity of goods. Oftentimes, farmers use futures to hedge against falls in crop prices. We could probably see why that is. Typically, farmers want to make sure that they get a certain amount per bushel of wheat or what have you. Typically, with futures, no money changes hands when the contract is signed. It's only at maturity when the goods and the money change hands. So let's recap. We break assets down into real assets or financial assets, and from there, we break down assets into groups called asset classes, like stocks, long-term bonds, and derivatives. Markets for these assets exist to facilitate the flow of funds or cash from people and organizations, like firms or governments, to any people, firms, or governments that need those funds. We also discussed market efficiency and why it's important. Remember, the theory of efficient markets states that assets are fairly priced based on the information we have about them, which suggests that there should be no way to earn an abnormal return. Finally, we discussed the basic characteristics of several asset classes, like stocks and derivatives.